Hey everyone, welcome back to the channel. Today we're going to talk about a new indicator that's called the squeeze momentum indicator. And this is a really nice indicator for crypto because the traditional MACD or RSI sometimes are a bit lagging and they don't really take into account the volatility of the crypto market. And I think in this period of bull run where the cryptos are going crazy, a lot of you will be interested in this indicator because it's quite adapted to Bitcoin, Ethereum, and other altcoins like this. So without further ado, let's jump right into it. So this indicator is a volatility and momentum indicator that was developed by John Carter. It's a pretty old indicator, but still I think nowadays is quite relevant. And basically what it does is that it measures the relationship between the Bollinger Bands and the Keltner channels. So briefly, the Keltner channels are taking into account volatility and they measure the ATR, the average true range. If you don't know what this is, I've mentioned this in a video about Supertrend. I'll link it at the end of the video. And when the Bollinger Bands are within the Keltner channels, that means that the market is in low volatility and its other name would be called a squeeze. So when the Bollinger Bands go outside of the Keltner channels, then this means that the market is getting higher volatility and that's when we can make money. Now that we've seen the basics of this indicator, let's jump into the charts and I'll show you how to use it. Okay, now we're on Ethereum and let's install the indicator. So as always, you go to your indicators tab and you type squeeze momentum. I'm using this one most of the time, but you can try any one that you like. I think this one has a nice setup by Lazy Bear. I think it's the most popular one. So let's go with this one. And as you can see, it looks quite similar to a MACD, but the difference is that it's not only the average, the moving averages distance that it's calculating, it's taking into account the Bollinger Bands and the average true range. So just to compare briefly with the MACD, which I have a video on, by the way, if you don't know what is it, we can see that the setup is a bit different. It's not completely the same. It's a bit bigger, so I would think it's a bit more reliable than the MACD, although you can see it's a little bit similar. So anyway, that was just to show you about the difference with MACD. Let me just zoom in a bit on this to show you a bit more. It has two components. There is the histogram like this in bars, and the bars change color when they start decreasing. So you can see it gets darker shade when you reach the top of the bubble, and same here when it reaches the top of the round, you have something that's a bit darker red. And because of that, you can kind of tell when the market is going to have a bit less momentum. It doesn't mean it's going to reverse, it just means it needs a break. As always, with this type of indicators, they're not like reliable and it's not going to be a change of trend unless there's other factors that would indicate that the price can move. So don't jump into conclusions too quickly. And the second part of the histogram is these little dots here. And you can see that anytime they start to change like this indicates that the price is going to, not really the price, but the momentum is going to reverse and to change color. So you can see the dots appear every time at the end here and when they're changing. So you can kind of tell that this wouldn't be really a reliable signal. And then the second part of the histogram is this little dots here, and they appear when the market is in a squeeze. So as you remember, the squeeze is when there's low volatility and that the market is kind of accumulating the momentum. And usually the longer the dots stay, the bigger the momentum will be and the bigger the price will move afterwards. And you see here there's a pretty long squeeze where there's a lot of candles that have this kind of little dots. And after that we have a big histogram move. And if we check at the price, this kind of corresponds to where the market was not moving a lot and then it breaks through and has a big move up. So that's how you use the little dots. It's telling you also when to avoid trading because this means that the market is consolidating. So for example, around here, you see that there are little dots appearing and you would know, okay, maybe I would just be better off waiting for the market to finish the move here and keep moving up or then reverse, because you see the squeeze is going here. And when the squeeze stop, then boom, the price starts to explode up. And that's what you can call the squeeze momentum power. It's that it tells you kind of, it can predict when the market will have enough momentum to make a move. So a bit like similar to the average true range, it's helping you to know when to avoid consolidation. So that's also a plus with the MACD that doesn't tell you anything about what the market is, when the market is consolidating or not. And that's why the strategy can be quite similar to this. We wait for the squeeze momentum to have the little dots, and until the dots stop, we just don't do anything. We draw a box where the market is starting to consolidate. For example, here we have also a nice support, or we can make it a bit smaller. Like here, if you don't know how to draw supports, I have a video on this and on price action, so I recommend you go check it out. It's going to be really useful. So let's just say that this is our consolidation zone, and we are here waiting because we see the little dots. And also, we can wait that the market reverses, where this indicator starts to be green. Then that's where we have much more chance that the market will go up. So we wait for these two confluences, that the little dots stop while the market is green. And it's very important that if the market is green but already going down, like if it's already in the darker shades, then you would not enter a trade. And we wait for the price to break through. So here we could potentially enter on that candle if we consider that it's strong enough. Or I would rather probably, for myself, enter on that candle. So you would put your stop loss underneath the zone. If you want to be really aggressive, you would put this here, but I wouldn't recommend it, because here, if you enter at the breakout, there can be a retest, and retests can be tricky and really take you by surprise by going a bit deeper into the area. So I would recommend just putting this under the zone. Of course, the risk to reward would not be as good, but you can just target a solid 2 to 1, and with that you're pretty safe that if the price reverses, you just move on and wait for another setup. But you don't try to get the whole move. It's really we're trying to catch the core of the move, because this is like the market accumulates energy, and then when it goes up, it will just have one strong move. And we don't really care about following the whole thing, because as you can see here, there will be another place where the market just consolidates before going through. And the reason why I chose to show you this on crypto is because this is especially effective on crypto. If you are familiar with this type of market, it's a bit less following the trend, like going, retest, going, and then correcting, and so on. The way it works a lot of the times is like this. It just has a long consolidation. It just has a long consolidation zone, and then when it breaks through, it never comes back to retest. It just goes like skyrocketing, and then it consolidates again, and so on. So of course you can see that after a while it will retest the zones, but that's how crypto work. And because of that, you are really better off using a squeeze momentum indicator rather than the MACD, because for crypto there's more consolidation. So it also is a way to avoid this and to avoid all the little tricks and wicks, like for example this one, where you would just get stopped out. You would wait for the squeeze momentum here and just draw your box. For instance, like this would be a pretty big consolidation box. You would do it all the way to here. And like this, when you wait for this to break through, you, for example, put this here. And here, I think it would be safe to put it somewhere around. And again, you target a 2 risk to reward, and that would be potentially good. I don't know if this one works. Probably not. Yeah, it doesn't work. But that's okay. You just do this. Of course, you backtest it. And if you see that there's a problem in the way you are having results, that they're different to what you expect, you can also try to add another indicator like an RSI divergence or you have to wait for fib levels, for instance. So you have to test it out yourself before jumping into the strategy and make sure that this is actually working for you, because it also depends on the way you draw your support and resistances. And now, because you stayed until the end of the video, here's a little bonus tip for you. I also like to use this in pairing with the super trend indicator. The super trend indicator is also very nice at knowing when the market is in a trend and in a nice trend. And it's also taking into account the ATR, so you have a bit of a safer stop loss. You can just put your stop loss at the super trend indicator at the line here, and then you will have a nicer indication and a confirmation that this could work. For example, here you would wait for the buy signal as well as the momentum to be going up with the squeeze before, and that would be a perfect setup. So this is obviously a loser, as I showed, but this is like the really type A setup that you would want to look for your trades. Now that's the end of the video. I hope this was useful and that you learned something new. If you liked it, please share a comment, subscribe, and don't forget to like the video. It really helps a ton. So thank you, and I'll see you in the next one.